Hello and welcome to this very special series, Outlook 2017, where we've chosen just a few handful of experts to tell us how the world is looking for the next 12 months. The world globally and locally is probably more uncertain than we've known it for so long, because so much has happened in 2016 with Brexit, Donald Trump, demonetization. Where has it left the world of equity markets as we enter a new year? My guest today on the show is Manish Chokhani of Enam. Manish, thank you very much for joining in today. How do you feel about the world today? I mean, it seems so uncertain globally and locally. What's your crystal ball telling you about what kind of phase we are about to enter?
Well, first I wish I knew. Crystal ball gazing has been very hazardous. This year itself, which has gone by, it started terribly, then did so well, and then again cracked in November. But like you said, if you had said that there will be Brexit, demonetization, the arrival of Donald Trump, Italy probably thinking of leaving Europe, markets should have fallen apart. And the fact is we are holding on, we are resilient. And we are seeing for the first time emergence of domestic flows offsetting global flows. And reality is the foreign inflows this year in the secondary markets have now been, barely $4 billion this year, which is nothing on the base which they have. So there is hope around India. The world certainly has never looked more scary and more volatile. India also, with now demonetization and GST, is heading into a period of uncertainty and earnings look very tepid. But, you know, as you say, hope springs eternal. There's a lot of macro things which are headwinds for us. And yet, there are demographic trends, entrepreneurial trends which are tailwinds for us. So on balance, I'm cautiously optimistic. I think that's the best way I can sum it up.
What's the global backdrop looking like? Because, I mean, the dollar's on a tear, market did not fall after the Donald Trump victory, and bond deals are rising after so long. I mean, where does it keep the global market backdrop for us?
So, I mean, globally, look, after 2007, and we've spoken on many occasions, it's been completely schizophrenic. So we go from complete euphoria to complete gloom in a matter of 6 months. And I suspect it's something like that currently going on, where you have the Fed chief saying we will hike interest rates, suggesting the US is doing well. And at the same time, the incoming president says they want to run a stimulus package, which suggests the country is not doing so well. And in a country where the Federal Reserve is leveraged 99:1, one would imagine a 25-50 basis point interest increase would basically bankrupt that. Or a hike in fiscal deficit would again bankrupt that country and the unfunded liabilities that sit in the US, which by the way is the best economy out of the whole developed world. It's a bit bizarre, and with the $150 billion infrastructure spend that Donald Trump talks about, we've had a global rally in infrastructure and metal stocks, forgetting that actually China used to spend $1 trillion, and yet these were flat on their back 12 months ago. So it's really confusing, and I don't think macro bets one can hazard. The clearest trade, of course, today is, the euro is clearly going to 0.9 against the dollar, and it's going to fund the carry trade because the dollar is surely going to rise, the euro is surely going to fall. And what repercussions that has for emerging markets is pretty grim. So in that context, if India loses its, macro stability, which this government has done very well over the last 2.5 years, because we were considered fragile 5 and now we're considered one of the shining stars. Juxtaposed with the fact that this should be a growth market given that we have unit volume growth. That's the long-term outlook why long-term investors have remained interested. But the short term, surely, FY17, I'm guessing we will end with zero earnings growth. FY18, who knows what happens with GST around the corner, with UP elections around the corner, what the behavior patterns are. And we're still at the heart a really small economy.
Yeah.
When I look at the profit pools and the size of the economy, it just doesn't tally with the real size of this country. And I suspect the answer at some point will come through currency adjustment. I can't for the life of me fathom why the rest of the world blew up and our currency went from 40 to 70 with oil prices falling off the way they did. Now, of course, they've come back, and that's another headwind for us on the macro side. But unless we manage to fix currency, I can't see how we create a very, very long structural bull market over here.
Is there a case for a global bull market right now in emerging markets? Or
I mean, look, you've come out of 35 years of the bond market went from a high of 1980 in terms of interest rates to a low which basically has ended now. So it's a 35-year super cycle for bonds which have ended. And the reflation trade where, every time something happened, you had effectively the central banks coming to bail you out. And that kept equities afloat, asset prices afloat, and the gush of liquidity which went around the world. So something has turned in the world. It seems to me, in technical parlance, it's an extension of a bull market rather than a new bull market in the world. And people trying to keep a plateau in economies which clearly have run the best by date. So if you look around at Japan, you look around at Europe, you look around indeed at most of the US, really all the votes that are now coming to these nationalist, right-wing, kind of tribal type leaders is a reflection of that growing frustration in those economies that were ex-growth. In that scenario, to call bull markets is really difficult. The predication, of course, in US is that Trump will get the $2.5 trillion of corporate assets stashed overseas back, and you get a wave of buybacks in US, you get a tax bonanza there. But that's not the stuff which makes lasting bull markets. Also, with a rising dollar, it's going to be tough for emerging markets. So I can't really make a good macro case to say that you should be here. And yet, when you go and do bottom-up companies, and you see the work which is going on over there, and the relative size, that gives you hope that surely this company can't be this size 5 years later. Again, just to give you small examples. Today, the profit of just Reliance or TCS is greater than the entire FMCG, auto, durables, retail sector put together.
That's bizarre.
All of them put together would make about $4 billion. And when I take auto, I'm including Tata Motor, but excluding the JLR piece, which is overseas. When you look at it that way, it's like, where is this mythical Indian consumer if the entire profit pool of this category, so if I take FMCG, durable, retail, then you add even media, telecom, auto, it's under $10 billion.
Annual profits.
Annual profits, PAT, for this entire sector. And you look at IT, we make more than $10 billion. And while we are sanguine about prospects for Indian IT services, fact is it's a big profit pool. $13–14 billion is roughly our BFSI space. Oil and gas is 10. So it's really these three sectors which, predicate what's going to happen to earnings in India. It's not really the consumer yet. And that's what is perplexing, that if this country has to grow, it can't be on the back of oil and gas, or it can't only be like 30–35% weightage for BFSI in the index. Something has to lift us off.
Talking about opportunities, many such great franchises have collapsed 25–30% since the demonetization thing happened. Do you see it as an opportunity, or do you think there will be much more pain in 2017? They may not have bottomed out yet.
So, well, there is short-term pain, as I don't think anyone can disagree that if you basically take away half of the money stock and you take M1 into credit growth into velocity is GDP. So if M1 itself is halved, credit growth ain't happening, and velocity is certainly fallen off. So GDP is going to suffer. And when GDP suffers, whether it's for a quarter or two, I hope it's not beyond that. And I don't think it should be beyond that. But what it means is that earnings vanish. Now, in an air pocket where our earnings have vanished and we were a growth market, in a world where interest rates are rising and something else is happening in other countries which will basically take a flood of money in that direction, you could get interesting price points. So I'm not in a rush to say that things have bottomed out. Also, we are in December. A lot of people indulge in window dressing to keep their annual NAVs up. So what happens in January may be interesting. Also, I think a lot of people this time will watch not just the budget, but what happens to the big UP elections. Because the outcome of demonetization in some sense will reflect in that election. And hopefully if the ruling party gets it right, that gives a fillip to really pressing full steam ahead with reform in India, which surely is needed. And then you have, of course, the whole lineup of privatization and stuff like that. So if you look back next year at what could have transpired, India may have been in a very interesting space. So for long-term buyers, the next quarter seems to be a period where we should be making interesting bottoms. How sharp it happens and how deep it happens or how fast it happens, I can't predict. But certainly if you have some cash for the next quarter, it should be an interesting point.
How long will we have
to wait for earnings to pick up, Manish, because 3-4 years we've had no earnings growth. We were supposed to get it this year, then demonetization happened. Next year we're expecting, then GST is going to happen. At some point, do you think patience might run thin, that this elusive earnings recovery is like the capex cycle? Every year we expect it and it's not happening.
So, well, the reality is this year, October end, India looked like it was on the takeoff stage. And most companies you met at that point, well, even up to the first week of November, they said even post-Diwali, things are looking really good. So this pay commission money, the good monsoon actually had helped, and the thesis was playing out that we were ripe for earning acceleration. I suspect because now the base will become low, next year second half earnings will look spectacular. And by then you would have baked in GST and everything as well. So therefore I said that this first quarter of next year is when a lot of the uncertainty will come. And a lot of places your conviction will get tested a lot. There will be flows surely, because if ETF money has come and they don't see earnings in India, there may be flows out of here as well. And it's reflecting in the market that the large caps, which are largely foreign owned, actually are now trading cheaper than a lot of the mid caps. So in some sense that churn is already happening. But I won't be in the camp which says earnings in India are a mirage and they won't come. I think it comes with high velocity at that point. And you then won't be surprised seeing 40, 50, 60% jumps in a lot of companies as operating leverage kicks in. And at which point you look back and say, I should have been shopping around this time. Which is why I say it's cautious optimism. It's not unbridled bullishness. One would like to be, but you can't really build that case today. I think there is room for prices or time correction. And I suspect, given India's attractiveness as a long-term destination for every seller, you tend to attract a buyer, and therefore the market really doesn't sell off. You get rotation among sectors, and we don't make one low on one day where everything collapses like 2008. But from time to time things sell off, and that gives you attractive entry points.